Just because a strategy can make money doesn't mean it makes sense for your life. Active investing is optional, not required, and it's not foundational for long-term wealth, and definitely not the only way to get started. When you understand your time, your risk tolerance, your wealth goals, you can choose the path that supports your life instead of overwhelming it. Hi, I'm Jonna. I'm a real estate investor, entrepreneur, and mom who built long-term wealth through real estate, all while my husband and I balance full careers and family life. If you're earning a good income, saving for retirement, and doing all the right things, but still feel like your money isn't creating the freedom or security you want, and you want a great life, you're in the right place. Let's get started. Hey friends, welcome back to Real Estate Investing for Life. I'm Jonna. Let's get started. We are in part 2 of our series right now about what type of investor is right for you. So today we're going to get started with one of the biggest topics, or one of these strategies I think that we hear the most about on social media today, on coaching content and courses and all of the investing noise that's out there. And that is really as it relates to active investing. The title of our podcast today is Active in Real Estate Investing Explained, and why it's not the best starting point for everyone. In the last episode, we talked about how to figure out what kind of investor you are by asking 3 key questions. If you haven't listened to that, you're going to want to make sure you pop back over and listen to the last episode. But it's how much time you have, what your risk tolerance is, and what you really want real estate investing to do for your life. You need to know that, or else you're not going to last very long. And today, we're going to go deeper into one of the most misunderstood categories of investing, which is active real estate investing, what it really is, who it's for, and why it may not be the right starting point for your life and your goals. It may be, but it may not be. I see so many new investors, especially high-income earners, who start out by diving straight into active investing strategies because they see that online, and that's what some of the loudest coaches are selling out there. And then you know what happens? Here in Idaho, they join our network, which is great, but then they burn out. They get discouraged. They quit before they even buy a rental property that could change their future. And so today we're going to slow down, we're going to zoom out, and we're going to give you the clarity that most new investors never receive. Let's get started. Part 1, here's what active investing really means. In a nutshell, it means that you're actively involved in creating the outcome. You're not handing a property to a property manager and collecting rent. You're not investing passively into a fund. You're not buying something turnkey and just letting it grow. Active investing requires time, decision-making, project management, energy, a high tolerance for surprises, and often emotional stamina. These strategies can be powerful, but they're also work. And I want to say this clearly, especially for busy professionals. Active investing is not passive income. It's a second job. So for certain people, that's so exciting. For others, it's exhausting. For multi-passionate entrepreneurs, it can be a really good thing, but I would still question how effective are you going to be, and imagine how much more wealth you could build down the line if you could just focus on your primary source of income and invest the funds into something that grows over time. But that's another subject for another week. Let's talk about the most common active investing paths. The main investing strategies are really these big few, and the first one is fix and flip, or home flipping. And this got popular back in the, I want to say 90s, when we started getting the, it wasn't even HGTV, but the TLC shows about flipping the houses and trading spaces. There were all of those kind of shows out there. And then HGTV came along and really glorified this fix and flip world that we live in today. And what it is you just buy a distressed property or a heavily run down property, you renovate it, and you sell it for a profit. Why do people love it? It's kind of sexy. It has fast potential profit. It's creative and fun, and it's a great way to build capital. So, if someone has a lot of time on their hands and they're handy and they're creative, I think it can be a great thing because they're getting, hopefully, if done right, these chunks of cash to put into something bigger down the road, maybe a full-fledged rental property. But what's actually required is you need to find discounted properties. You need to coordinate with contractors, manage budgets and timelines, handling surprises, and there will always be surprises, even with the most simple renovation. Believe me, we renovated our own house this year. Man, were there surprises. That's another show, too. Understanding market values and staying calm under pressure. These kind of opportunities with fix and flip are best suited for people with time, construction skills, and a high appetite for short-term stress. No matter what, there's usually some sleepless nights involved. And why do many beginners struggle? Well, there's a number of different reasons, but most high-income earners, they don't have time to manage a renovation, and flips can turn into money pits quickly. I have some nightmares for people that have come to us after they have unsuccessfully tried to flip homes, especially from afar, let alone just having a full-time job in the same city where the flip is. When people are not supervised correctly and you don't know how to hire the right contractors, things can and will happen. Again, I mentioned we've renovated our own home. Well, we've had it renovated by contractors. Even when you have those situations where you're there on a daily basis to the job site, things happen that are unforeseen. And so there's always going to be those surprises. And it's amazing how quickly a project can get derailed and get underwater, meaning negative money when you go to sell a house. That's never fun. The second highly active form of investing that you hear a lot about out there in the headlines is the BRRRR method, which is buy, rehab, rent, refinance, and repeat. It was a term that came from Brandon Turner, who at the time was Bigger Pockets, and he started to talk about this BRRRR method. And I remember when it was first mentioned on a podcast many years ago, I think, and it has just taken off like wildfire. And the strategy gets a lot of attention, and with duly so, because it allows you to recycle your money. So why do people love it? It builds equity fast, theoretically. It has the potential to acquire multiple rentals with the same funds. It has a strong capacity for long-term wealth building. And here's what's actually required: deep market knowledge. This is a situation where more than ever, you make your money when you buy. Like, you've got to buy it at a discounted enough rate that you have room to put in that rehab and refinance it and get your money back out. And it's a very different situation than if you have a long-term rental that you're planning to hold for 20 years, because real estate is really quite forgiving if you give it time. But if you need that turnaround and be able to refinance it within, say, 6 months, it's so critical that you buy right. So you need that market knowledge. You need, just like with flipping, you need reliable contractor relationships. So important. You need to know how to manage renovations, even if it's just managing the contractors. You need to know how to navigate financing and appraisals and getting the right kind of financing and what kind of short-term money you're going to get in the meantime to purchase the property. Again, because you're going to rent it out, you need to understand rental rates and rentability for that house and what makes it a strong rental. And you need to know how to handle project delays, which are never fun, but these are really best suited for people who enjoy construction, problem solving, and complex deals. Here is why a lot of beginners struggle, from my perspective, is it's a cool term, but it's not easy, and it's not passive. So if timing or appraisals work against you, then your return disappears. I've seen this happen to folks, and they're counting on an appraisal at this amount. But appraisals are a funny thing. You can get 2 appraisals on a property and have them be wildly different. I've had them be as far as $100,000 apart. And when you're relying on that one appraisal to come through for you to be able to refinance this property and get you out of a high interest rate loan, that's a risk. So go back to the last episode and assess your risk for that. It can be a very great product, but you just need to know the risk that's involved. Hey friends, are you struggling to figure out what type of investing path is right for you and what fits your personality type? Fun news, I've got a quiz set up just for this purpose. Take 60 seconds and head over to jonnaweber.com/investor quiz. Fill out your profile and we'll figure out what type of investing is right for you. The third key term that we hear all the time that makes us think of active investing is wholesaling. And wholesaling, in a nutshell, is when you find a discounted property, you work with the seller and you get it under contract and you assign the contract to another investor and get paid a fee. So in practical terms, let's say you find this man, John, that wants to sell this property, get it out from under him, and he needs it under contract in the next week. You, quote unquote, tie up that property, you put it under contract at a certain price. And again, this is where it's so critical you buy right or get it contracted under the right price. And then you find an end buyer that's going to purchase that property, and they will pay you a fee for finding the property and getting it under contract. Make sense? If not, let me know. We can explain that further. But here's why people love it. One, a lot of people get started this way. There's very low money required theoretically to get started, and there's quick cash potential, which is great. The thing is, I say there's low money required, but the truth is a lot of the wholesalers that I know spend thousands and thousands of marketing dollars per month to attract those sellers, to have those conversations, to get them under contract in the first place. But it is a great introduction to market valuation. The more houses that you look at and the more sellers that you talk to, the more you are going to find out about sellers' motivation and the more you're going to get to know your local market. So it could be a really good thing, but here's what's actually required. High volume marketing, which is the expense I just alluded to, cold calling, texting, negotiation, thick skin, a lot of hangups, consistent follow-up, and building a cash buyer list. If you want to look at an example of a couple of wholesalers in the market and see what they do, you might want to check out Ryan Weimer with Offer Now Idaho. He talks about, I think there were hundreds of calls involved before he got his first seller appointment. We have another great couple in our Idaho community, Paul and Denise Myers, and they talk about the stories of going in with those sellers and the long game and how much education it takes to truly get good at this craft, because it is a craft, going in and purchasing properties or getting properties under contract off market. And it's not something that you can just walk in and do the next day successfully in most cases, whereas you could walk in and purchase a rental successfully. So there's a disconnect there. It's really best suited for people that want to run a sales and marketing business because that's a huge part of it. It is a business. It's not passive investing. And I think part of the reason that many beginners struggle is because to be successful, you want to be full-time, you want to be in marketing, and true professionals that are out there earning a good living doing something else rarely have the time that it requires to do it right. So one might be better off just purchasing a deal from a wholesaler and getting started that way. Another great example of active investing is short-term rentals, and that's renting a furnished property nightly or weekly. Most of you know it as Airbnb or VRBO, okay? And there has also been a lot of chatter out there right now as far as professionals getting an Airbnb for the ability to claim a real estate professional status. Again, this is something that we can go into at greater depth at another episode and that I go through with my mentoring clients. But the short-term Airbnb, if it's self-managed, it truly is an active income thing. It can be great. There's a lot of nuances involved in how to purchase the right area, the right demand, all of that good stuff. People love it because there's a high revenue potential. It's considered fun for hospitality-minded owners. There's gorgeous design opportunities if you're into that. You can even purchase in a market where you like to go visit, which is always a fun idea. And what's actually required in some of the most non-glamorous sectors or parts of the short-term rental business is that there's constant turnover. Even for the most successful rentals, there's even more turnover because you're constantly changing out who the guests are and you've got multiple guests per month. So there's constant turnover, there's guest communication, putting all these systems in place, cleaning coordination, review management, pricing adjustments, handling emergencies, which there truly are sometimes emergencies in Airbnb, and ability to navigate regulations. I just saw an example of something on Facebook yesterday where people are fighting tooth and nail to get Airbnb kicked out of their community, or short-term rentals in general. I shouldn't use Airbnb is more like a brand name, but short-term rentals kicked out of their community. And think about if you had purchased a short-term rental in that community and all of a sudden this thing that you had intended to use as a short-term rental, it's no longer an option, there's some risk involved there. It's really best suited for people who really enjoy hosting, customer service, operations. But a lot of beginners struggle because they realize it's a hospitality business. It's not true passive investing. Next, we're going to jump into midterm rentals. Now, midterm rentals aren't quite as active. They are houses or apartments or condos or what have you that are 30 to 90 day stays for travel professionals. It could be even a little bit longer than that, 6 months. They're usually furnished though, and they include utilities, and they are great for traveling nurses, teachers that are teaching abroad, all kinds, meaning they've come to the U.S. to teach for a semester, an adjunct professor or something like that, or even if people are coming here or to whatever town working on projects for a corporation, time-specific projects, that's a lot of times where we'll use these midterm rentals, or people moving to an area and they just want to get established while they learn about the area before they purchase a house. Why do people love it? They love it because it typically is higher income than long-term rentals. There's definitely less turnover than Airbnbs. They have a stable guest profile. And the thing a lot of people overlook, though, what's actually required is there's furnishing, guest screening, handling turnovers, understanding seasonal demand, and listing optimization. So this is best suited for people with time availability who want better cash flow without nightly turnover. And many beginners struggle because it's still active, still work, still operational. The last piece of active investing I just wanted to touch on, and we could go way deeper into that on a one-on-one basis, but that is the idea of development. And people love the idea of development. I've always wanted to create a little infill community, or I've always wanted to put together a work-live balance type little strip mall, all kinds of examples like that. Or I wanted to put in storage units. That's building a home or multifamily or a construction unit of any kind from the ground up. And people love it because, of course, you get to create something. You have long-term appreciation. You have significant equity potential. But what's actually required is managing architects, engineers, city planners, permits, inspections, construction timelines, and large budgets. Why do new investors often start with these active methods, and why that's a problem? So here's something I see consistently. New investors think they've got to start with these active methods. Why? Because that's what dominates social media. That's what the loudest coaches are selling, and that's what looks exciting, fast, flashy, and profitable. But here's the truth. Active investing is rarely aligned with the schedule or lifestyle of a high-income professional. My goodness, you're already working full-time, you're already raising kids, you're running a business, you're serving clients, you're traveling, you're living your life, and most active strategies require constant decision-making, unexpected fires to put out, phone calls at inconvenient times, managing contractors or guests, dealing with surprises or setbacks. And that's when I hear things like, I tried real estate, it was too stressful. I felt like I was failing before I started. I thought I had to be a flipper or do burrs to make it work. But you don't have to start there. And for most high income earners, you shouldn't. Active investing makes sense in certain situations. It's perfect for someone who loves the process, enjoys construction or design, has time to manage projects, wants faster growth, has a creative streak, finds fulfillment in being hands-on, has a high tolerance for risk. If that's you, wonderful. This series will help you understand that too. But the key is knowing your investor type before you jump into an active strategy that doesn't fit your life. So I want you to remember this. Just because a strategy can make money doesn't mean it makes sense for your life. Active investing is optional, not required, and it's not foundational for long-term wealth, and definitely not the only way to get started. When you understand your time, your risk tolerance, your wealth goals, you can choose the path that supports your life instead of overwhelming it. In the next episode, we'll explore the semi-active strategies, that lane in between, that can offer higher cash flow than passive methods, but without the intensity of flips or burr. And if you haven't yet, take our investor quiz. Hop on over to jonnaweber.com/investor quiz in the show notes as well. And that'll wrap up today's episode. Can't wait to see you on the next one as we explore the semi-active passive investing path. So good to see you here. If you enjoyed this episode, please give it a like, subscribe, and a 5-star review. I'd be eternally grateful. You guys have a great day. Go and grow, and we'll catch you on the next episode.